Today I'm going to be diving into the performance of an automatically hedged liquidity pool so I can show you what this actually looks like in practice. Now, full disclaimer, one of our members of our consulting service built a script that automatically adjusts a hyper-liquid hedge on a liquidity pool to ensure full delta neutrality. And that's a lot of complex jargon right there, so let's break that down a little bit basically. Ultimately, it finds out how much ETH is in that liquidity pool at any given time, and then it rebalances the actual hedge, meaning that it will go and it will open a little bit more on the short or close a little bit on the short to balance it with what's actually in the liquidity pool. Now, I want to show you the exact performance behind this strategy, and as you can see right here, so far the liquidity pool itself is doing 73% APR. So while this looks really good on paper, it's actually not holding up to what you would expect, and I'll show you why. First things first, we need to look at what we're actually doing. So we have a $7 profit from the assets going up in the liquidity pool, and then a $7 profit from earnings, meaning that in total, we're at about $14 in profit. The thing is, this hyperliquid account is down $15, meaning that there is about a $1 discrepancy right here. So we're actually down a little bit more than what we're up over here, meaning that even though we are delta neutral, we have lost a single dollar. But on top of that, this negative $15 should be equal to this plus $7, but it's not. It's having to dig into our earnings just to retain profitability, and even then, it is not profitable by $1. The reason why is because how these scripts work, and this will answer a lot of the questions that you guys have had, because a lot of you said, couldn't you just do this automatically? This script is ultimately closing your short a little too late and opening your short a little too late, ultimately. And then, of course, the market starts to rebound or the market starts to move the opposite direction, and you start to lock in impermanent loss on your actual hedge itself because the market's constantly moving. And there's a couple different strategies that you can do to mitigate this. The first one being is under hedging or over hedging and just taking a little bit more of a directional risk. That's actually what I did here as well. I started with about $900 on the hedge, and I had a $930 deposit into the liquidity pool, meaning that I was 96, 97% hedged. Truth be told, this would probably be profitable if I were to do this with a 90% hedge, basically, and I would be able to extract a decent bit of earnings, I would say. But in this case scenario, it just doesn't work in that situation. The other thing that we have to keep in mind is the market is always moving different directions, and the parameters that we use on something like Ethereum, when it comes to rebalance triggers and adjusting the short and stuff like that, cannot be the same parameters that we use on something like Bitcoin, or even something like Link or another altcoin or something along those lines. So that's another finding that we found. Another thing is we need to look at correlated assets, but also look at ones that have a low price volatility. So when we're looking at assets, instead of doing Ethereum to USDC, where you're battling between having market exposure and not market exposure on your hedge, we would rather be in something like ETH to wrap Bitcoin, where you're not battling for which one has market exposure, you're battling for which one's going up more or down more, basically, and you're adjusting your hedge based on that. And that would most likely be more profitable than what we're currently running. Another thing that we could adjust is the actual trigger behind the rebalance. I'm willing to bet that rebalancing less often would actually become more profitable, even though you're not going to be fully delta neutral. And the reason why is because, again, if you kind of wick down, let's just say by $10, $15, and your position slightly adjusts and it rebalances, and then it just goes right back up, and then it rebalances again, and again, it's doing those rebalances too late, you're just locking in unnecessary and permanent loss in your actual hedge. So feeding it some market data as well would be a way better decision in that regard. And again, all my assumptions and claims, they are based on data and based on what I personally think will work / won't work based on my experience in the market. A lot of people out there just like to throw out random claims, throw out super high APRs to get clicks. Again, I want to be reasonable here. So with that being said, I want to show you a position that I'm also running, this one at a much larger scale, that I am manually hedging, and show you what that looks like in terms of performance. So this right here is wrap Bitcoin to USDC, and I'm hedging out the wrap Bitcoin portion. Now, one thing that I want to show you is I started out this position by hedging only 90% of the wrap Bitcoin that was in this position. So under hedging a little bit. In addition to that, this profit loss is the actual profit loss reflected because it includes the hedge on this Metrix dashboard in this case scenario because I added it here. The other one, I didn't add it there because it's constantly rebalancing and we don't have that support quite yet. But when we break it down, you have the liquidity pool, which is wrap Bitcoin to USDC, and I started there with about $10,000 or so. And then you have the hedge, which is just a Bitcoin hedge. Now, here's why I under hedged this one initially. Notice how I started with 55% wrap Bitcoin, now I have 52%. Well, if I had hedged an exact of 0.0642 wrapped Bitcoin, then what would have happened is whenever Bitcoin did start to perform, I would be shorting more Bitcoin than what I have, meaning I'm shorting a market while the market is going up. And that's not a good thing because I'm going to start to lose money on the way up. And in my opinion, I still think we're in a bull market. I don't think we're in the best spot of a bull market, but I think we're in a bull market still. So again, that means that my direction needs to be bullish to be able to make profitability. Now, over time, my earnings are going to build up and up and up and up and up, basically. And in this instance, I have not rebalanced this hedge once. At one point in time, I had 65% wrap Bitcoin, and I was still at a profit. Not much because it had to dig into my earnings a good bit because, again, I was under hedged, but I was still at a profit in that regard. So again, it's all about being patient with these types of positions. This one is actually doing a 70% APR, which I think is really great. But remember, there are going to be some times where it has to dig into those earnings, and that will affect your APR. And that's why APR is not the most important metric. It's how much money you can actually extract from this and put into your wallet. Now, very quickly, if you're a little bit confused, or maybe you just want to implement these strategies, I'm hosting an emergency webinar on Monday where I'm going to break down the exact process from going from stablecoins to getting into LPs and actually adding hedges to those liquidity pools, and then doing some other strategies like funding rate arbitrage. And that's because, again, right now, a lot of people are bearish on the market. A lot of people are uncertain, and maybe they want to mitigate some of their downside risk, even if it comes at the cost of their upside. And that's what we'll be covering on Monday. So if you guys do want to grab your free ticket to that, the link is going to be at the top of the description. Again, worst case scenario, you walk out with a ton of value for completely free. You guys know the drill. Now, another thing that I want to go ahead and mention, this right here that you see is the liquidity pool itself, right? So the liquidity pool itself is doing 70% APR. We have to put capital on the hedge as well, which means that we need to look at our effective APR. So the way that we get to that effective APR is we, number one, find out how much we actually have as margin over on Lighter, which is where we're hedging in this instance, and then do the same thing for liquidity pools and find their respective returns. Now, in this case scenario, we're actually getting paid to hedge. We're getting paid 9.4% per year, which also helps the overall health of the position. And that's because there is a funding rate. That funding rate is essentially the longs paying the shorts because, of course, the market needs to be balanced out. Now, here's the thing. That funding rate is about 5%, but that's 5% of the overall position value. The position value in this case is $5,000 or so, but the margin is $2,500, which means that the effective rate that we're getting on our margin is 9.4%. And then we just simply run a weighted average on these numbers, weighted by the actual capital amounts that they have. And right now we're doing a 56% APR on this Delta Hedge liquidity pool. But keep in mind, this is not delta neutral. This is a pseudo delta neutral position, meaning that it is somewhat delta neutral, right? It is partially hedged, but it is not fully delta neutral, and it is not a one-to-one balanced delta, basically. So that's just one thing that we have to keep in mind. But again, with these types of positions, we can generate a good amount of profits with a minimal amount of market risk. Because again, if we're under hedging and the market starts to go down, sure, do we have some loss exposure? Yeah. But if the market starts to go up, we also have that upside exposure as well. And then in the meantime, we're generating fees. And in my opinion, those are the types of positions that make sense right now in the market. And of course, you shouldn't allocate all your money to delta hedged LPs because there are going to be the times where the market just tanks. And of course, your position does not perform. That's part of the game. That's going to happen. And that's why I'd recommend also having a balance with stablecoin positions as well. I have a good chunk of money in stablecoins. I think the majority of the capital in this portfolio is in stablecoins that either have yields of 15%, 18%, or have yields of 5 to 8% or something like that on the lower risk ones. And it's all about balance, risk diversification, and generating risk-adjusted returns. So all in all, this portfolio is doing like 25 to 30% right now, and that's exactly what I'm going to show you guys how to build on Monday. So if you guys found this valuable, again, let me know down below in the comments what content I can make that will help you guys out navigating this complex DeFi space. I'll be happy to do so, and I'll see you guys next one. Peace out.